When a bank pulls your credit, they don't see what you see. And that misunderstanding is why approvals feel so random to you right now. So just give me the next 5 minutes and I'll walk you through what I actually see on their screen and why it explains almost every confusing denial that you've ever had and continue to have. Before you watch this video, my name's Carrington and I help business owners become bankable and create systems to scale their business. I help you understand the lender side of the table so credit stops feeling like a guessing game and starts working like a system. Every video I share gives you one thing you can use immediately. No selling, no fluff, just straight clarity. And I'm going to reference my bankability checklist again here because it mirrors the exact sections lenders use whenever they are reviewing your consumer credit profile, not the apps. Most entrepreneurs think banks are looking at the same Credit Karma dashboard that they are. They're not. And that's why someone with a lower score sometimes gets approved. And with a higher score gets denied. It's not favoritism, it's straight visibility. So this is what most entrepreneurs are doing right now. They monitor their scores daily, celebrate point jumps, and also ignore everything because no one told them that it mattered. So when a denial hits, it feels personal and confusing. You'd be like, I have a 720 credit score and how the heck did I get denied? Someone with a 680 just got approved. What am I doing? What am I missing? What am I doing wrong? And so this is why that doesn't work. Because lenders don't see a score first point of view, they see a risk profile. And that profile answers one question only. Can we trust this borrower right now? And will they pay me my money back? And then some. Your score is just one piece of data in a much bigger picture. So these are the three key sections that lenders actually see. Number one, they see stability before score. Banks look at patterns, the account age, your payment consistency, the number of negative accounts in your credit profile, utilization trends. That's over time. They go to the FICO 10T Invention 4.0 model. And they see, are you using more or less credit lately? One late payment 3 years ago matters less than recent instability, and that's a fact. If your score is 750, but your utilization jumped from 10% to 70% in the last 2 months, that's a red flag. So banks see that as desperation and not opportunity. Number two, they see identity and consistency signals. The name, address, phone number, business info, all cross-check instantly. If your data doesn't match across systems, it triggers friction. Friction equals delay or denial. For example, your credit report says one address, your bank registration may say another. Your bank account lists a third. Even with a score, that mismatch tells the lender that something doesn't add up here. And when something doesn't add up, they pass. They panic and that causes a denial. Especially if you're going to the automated approvals, which is online applications. And the last step, number three, they see intent through behavior. Multiple applications in a short window. High balances that's reporting. Recently opened accounts with no strategy. That tells a story even if your score is high. So banks don't read numbers, they read behavior. And your behavior over the last 60 to 90 days says more than your score ever will. So if you're maxing out your credit cards, applying everywhere, and showing high utilization, you look desperate. If you're managing low balances, spacing out applications, and maintaining consistency over a certain period of time, you look strategic, and that's the difference. That's what we need to shoot for. So now this is why this works, okay? Because once you understand what lenders see, you're gonna stop fighting the wrong battles. You're gonna stop obsessing over points. And you're gonna start managing these signals. And that's how approvals become predictable. You're no longer wondering, why did they just say no? You already know exactly what they're looking for, and you've optimized for it. And that's how we win the game. And that's why this bankability checklist also exists. It translates the lender view into clear actions you can take right before you start applying. Instead of asking, why did they say no, you're gonna know. Here's what they're gonna see, and here's exactly how you can approve it. Because once you see credit the same way the banks do, you're gonna stop feeling judged and you're gonna start feeling in control.